Welcome to Macro Monday on Investec Focus Radio SA, a podcast about what's driving global and local markets. I'm Chris Holdsworth, Chief Investment Strategist at Investec Wealth and Investment. Every Monday morning, I'll update you on key developments from the past week and what you need to know about the week ahead. If you'd prefer to watch a video with the graphs and charts I referred to in the podcast, just go to investec.com/Macro Monday. This week, we're going to have a look at signs that global growth is accelerating. We'll have a look at what's happened to commodity prices over the last 6 months or so. We'll also have a look at signs that the Chinese economy might be slowing. And finally, we'll look at SA trade data. We're going to start off with signs that global growth is accelerating. At the end of each month, we get what's known as PMI data for a range of countries across the globe. And it's a high-frequency estimate of economic activity. Any number above 50 indicates a month-on-month expansion. Any number below 50 indicates a month-on-month contraction. And the latest global number is well above 50. At 52.9, it's close to the highest numbers we've seen in the past 3 years. So the latest high-frequency data does suggest that global growth, in fact, has been accelerating. Now, if you look at individual countries, over the past 6 months, we've actually seen a sizable upgrade to US growth forecasts. They bottomed in April around Liberation Day, but subsequent to that, we've seen a quite marked improvement in the economic outlook for the US, and with that has come a very sizable upgrade for GDP forecasts for both this year and next year, to the extent that the consensus forecast is now expecting GDP growth for this year to be about 2%, whereas at the bottom of the Liberation Day lows, the consensus forecast was for growth to be closer to 1%. And for next year, the current consensus forecast is that growth will be just a bit short of 2% as well. So you're looking at close to 2% per annum for this year and next year. That shift in forecast, the sizable upgrade, is unique to the US. If we compare that to Europe or Japan, there's been much less volatility in forecasts. So we saw a sizable downgrade in the US in particular around Liberation Day, and then subsequent to that, a sizable upgrade, while growth forecasts for developed markets have remained pretty stable. So it's a US-specific story. We've seen increased volatility, increased uncertainty around the growth outlook for the US, in part due to trade policy in the US. Just taking a step back and looking at global growth, it's not just the PMI data that's suggesting that global growth is accelerating. So far, we've had GDP prints for 20 of the 60 countries that we track for Q3. Obviously not the US, given the shutdown. Hopefully that number will come out in the not too distant future. So we've had prints for 20 countries. Of those 20 countries, median growth is now sitting at 2.7%, which is up from where it was in Q2 and actually up from where it was for most of last year as well. So there's more than one sign suggesting that global growth is picking up. The most obvious sign amongst all the things we look at is commodity prices. Over the past 6 months, we've had pretty strong returns for copper, up 14%, for iron ore, up around 9%, and even Brent is up around about 2% over the past 6 months or so. So a range of commodities rallying, again suggestive of the idea that global growth has been picking up. And it's an important point to make, because at the beginning of the year, it was widely expected that global growth this year would start to slow down, as it was expected at the beginning of last year. And there's been this persistent growth coming through across the globe that's been above expectations. It's been pretty good, and the back end of the cycle has been pretty long this time around. It's not all good though. If we dig into the PMI data that relates to growth is signaling that everything is okay. In fact, global growth is accelerating. The PMI data that relates to inflation though is flagging concern with regards to the outlook for next year. Particularly if you look at the ISM Services Prices Paid series. This series typically leads inflation by about 4 months, and it's increased again, and it does suggest that there's quite material upside to US inflation forecasts over the next couple of months or so. So in effect, we're sitting in a position where growth is strong, but inflation is likely to be picking up too. And in amongst all of that, just to complicate matters for the Fed, the labor market is still looking pretty weak. We don't have the formal non-farm payrolls data because of the shutdown in the US, but we can look at private sector alternatives. And if we take an average of the two primary private sector providers, you're looking at job growth of about 20,000 last month. So it's a very difficult position for the Fed. You've got signs that GDP growth is good, but the labor market is weak. And in that environment, you typically might want to provide support to shore up the labor market. But in the back of their mind, there's this risk to inflation next year, which means that they're not necessarily going to be able to act in the way that the market expects, which is for a further 3 cuts by September next year. So we'll keep a very close eye on how that dynamic plays out. It would be a lot easier if we had formal data. The early indications are that this US shutdown will come to an end sometime this week, although that is an indication. It's not certain. It has been going for around about 40 days already. This is already a record length for the shutdown, and it is starting to have an impact on the economy, and of course is making life quite difficult for the Fed as well. So hopefully, as that shutdown comes to an end, we get some formal sector data, and then makes the decision making for the Fed and for markets in general a bit easier. But just to add to that, while we're waiting for the formal data, we did see a range of job cut announcements from US corporates during October. It was the worst October in some time, and it just adds to the narrative that the labor market in the US is slowing. Shifting to China, we spoke last week around the first sign of concern around the outlook for Chinese growth, and that was due to a series called Total Social Finance. It's a key leading indicator for the Chinese economy, and it was pretty weak for 1 month. And we said we just need to wait a little while to see if there's other confirming data points to suggest that the outlook for China is weakening. We did get that last week. If you look at Chinese exports, they're actually down year on year at this point, which is quite different from what we're seeing in South Korea and Taiwan. So this is not a global story. This is a China story in particular. So now we've got 3 factors pointing to a near-term slowdown in economic activity in China. We've got the total social finance numbers, the PMI data, which is still above 50 in China, but it was lower than it was the month before, and the exports that are now down year on year. It is just 1 month's worth of data, though. And while it is 3 different data points, we probably just need to wait another month or so before we can lock in the view that the Chinese economy is slowing. So the lights are flashing orange. They're certainly not flashing red just yet, and we just want a bit of time to be able to see what transpires over the coming months or so. But the high frequency data does point to caution with regards to the outlook for the Chinese economy. Switching to South Africa, the trade balance continues to be good and on point for the SA economy. The trade balance in September was 22 billion rand, well above the consensus forecast of 7 billion. And the 12-month number is now sitting just shy of 140 billion rand, which outside of the post-COVID period is a record high. So it's quite clearly the case that these high commodity prices we spoke about earlier have led to an improved trade balance in SA that's helpful for the rand, and also the corporates that are exporting will be generating greater tax revenues, and that should be helpful. And we should get an update in the medium-term budget policy statement, and we expect that government revenue is going to well exceed the forecast in February, removing the need to increase VAT next year. So we're at the point in the cycle where high commodity prices are transitioning to a benefit for SA Inc. Hopefully the Chinese economy remains robust over the coming few months or so, and then that allows the commodity story to persist, and we'll end up with a more permanent improvement in SA Inc. But we'll monitor that space very closely. And that's where we're going to end it for this week.
That's all for this episode. Do tune in next week for more investment insights from me, Chris Holdsworth, and the Investec Wealth and Investment team. If you haven't yet added us to your podcast feed, you can subscribe to Investec Focus Radio SA wherever you listen. And please take a minute to rate our podcast so we can surface this content to the broader investment community. If you want to see the graphs that are referenced in the podcast, you can watch a video version of this recording at investec.com/Macro Monday.
The views expressed are those of the contributors at the time of publication and do not necessarily represent the views of Investec Wealth and Investment International and should not be taken as advice, guidance, or recommendation. Investec Wealth and Investment International, a member of the JSE Equity, Equity Derivatives, Currency Derivatives, Bond Derivatives, and Interest Rate Derivatives markets, an authorized financial services provider and a registered credit provider.